So, for us, I just spent so much time making other people wealthy and, building up their portfolios that I just got to the point to where like, look, I'm ready to run, man.
Hello, everybody. This is Jake Stenziano, host of Wheelbarrow Profits Podcast, the #1 multifamily podcast on iTunes. Here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbo. Gino, how's it going?
Mr. Stenziano, I am doing good. And you know what? I have something in common with today's guest. I am in a basement making it happen on the podcast, right? I mean, you know what? You can't make excuses in life. The broker needs to get the offer in today. You don't make excuses. You make it happen anywhere. I mean, he's got a better excuse than me. He's fishing. I'm down here hanging out on a pool table. I don't know what I'm doing here. So
Mama's house.
That's right, Stenzi. What are you up to, Stenzi? Talk to me.
Listen, I'm always making it happen, big man. I'm excited about today's show. Today's guest is Benjamin Inman. Benjamin is the founder of Inman Equities and has grown his company to over $140 million in assets in just a few short years. Without further ado, Benjamin, welcome to the show.
I appreciate it. Thanks for the time, guys.
Hey, give us a little bit about your background and how you started your company.
Yeah, so I started my company. I was with Cardone Capital for a little while, and then once I left Cardone Capital, I left, and that was 24 months ago now. So really 2 years ago was when I left Cardone Capital, started my own shop, and here we are today. And we've done quite a bit in a short period of time, but you can't ignore the fact that it took 15 to 18 years to actually get here, right? It's just what we're actually able to do in 18 to 24 months. It didn't just happen. It just not something that just we decided to start a company and it just exploded. It was a process to get here. It's like 10 years to become an overnight success. Basically, it's what they say in Nashville.
So, Benjamin, let's go back even deeper. Where did you go to college? Why did you choose multifamily? Let's jump into that.
And so I started a little community college, and that's where I began, and then ended up going to University of Central Florida, UCF, in Orlando. And then from there, during that time, I had a landscape company that I started. I was desperate to get involved in multifamily in any way that I possibly could. And multifamily, just because I always tried to force myself to think big and not think small. People typically want to start in single family. So just like everybody else, that's where I started. I started doing landscape architecture for small single family homes, and then doing the installation, and then just kind of kept building up from there. And then ended up getting introduced to a large developer down in Miami. Landscaping just happened to be his passion. It's a 300 employee company. I only reported to him. So during that day, it was condo conversions this is back in 2005. And just really took me under his wing, became one of my first mentors actually, which was fantastic because he acquired multifamily properties for his own family portfolio. And then we were doing condo conversions in addition to that. Mm-hmm. And so really was able to cut my teeth with him. And that lasted until the recession of, I guess started in 2008. He kept me on board for another year after that. And then I went to Marcus & Millichap for a short period as an analyst. And then from there is when I was introduced to Grant Cardone. Didn't even know who he was at the time. And went in and interviewed with him. Interview went great. It was 2 separate interviews. And it was tough. It really was. But it was worth the ride. And after that time, I was just, during the whole course of that landscaping to where we are today, I read every book I could get my hands on. I listened to every audio book I can get my hands on. Back in those days, there really wasn't podcast, but every day on my commute down to, it was called Cardone Acquisitions at the time before the name changed to Cardone Capital, I was just pounding in my head, just podcast after podcast after podcast. And that's really how it all started in a nutshell.
What do you think you learned working at Cardone that translated into the growth of your company?
I realized a couple things. And one thing that Grant always said is you commit first, you figure the rest out later, right? So you just got to commit, you jump in and you get the job done. It's all about execution, because you can have somebody else at the table that's going after the same property as you're going after. They could be all perfectly prepared and chances are pretty high they're going to get caught up in analysis paralysis, right? Whereas with us, you just have to go in, you have to know your numbers, and you just attack it. And then you got to sell the broker, who's going to in turn sell the seller. And if you make it to the buyer interview call with the seller, then you got to sell yourself on why you're the best choice for that particular property to get awarded. Because everything in life is a sell, right? You're either selling or you're being sold. Another thing that Grant always said. And so, working with him, I realized, with all due respect to Grant, I have nothing bad to say about the guy. He eats, breathes, and sleeps what he teaches, but he's no smarter than I am. And I just had to come to the conclusions like, I can do this, and it's time to go. So, it was just a really good experience working with him. Is anything, most things are really simple, and multifamily is no exception. We tend to overcomplicate things when it really is, it's a really simple process. Once you have your steps in place, you can do anything you want.
I completely agree with especially what you're saying about the brokers, because so many folks get into this, especially early on, and they think that the broker is the salesperson. And I know I pound the crap out of this on just about every show, but you are selling the broker on why you are a closer and you're going to get the job done. And he brings up a fantastic point, and I don't want to miss this, because if you're not selling the broker on yourself, and then you get to that interview and you're saying, look, you're supposed to be selling me, I'm the buyer here. That is not the game we're in. I want to make that very clear, folks.
Not right now, at least. Not at this part of the cycle. So there's a couple of things also, Jake. Benjamin says, you have to commit first. And I think everybody gets scared of multifamily because it's a long game, because we're all in instant gratification where you buy a deal and you flip it in 6 months. This is not that. This is actually planting your roots and taking years. Like he said, it doesn't happen overnight. It can take 18 months to get a property stabilized and refied out. A lot of people don't have that time commitment. They don't have that dedication, or that, we're used to doing something, bam, that transactions don't equal wealth. They equal paying the bills. The whole multifamily game is a different thing. Can we talk a little bit about your process? Because I think processes and systems are so important in this business.
Mm-hmm. Yeah. So as far as from actually getting awarded a deal, right? Because the first deal that I did, I actually put in $0 of my own money because at that point in time, I didn't have anything to put in. Right? So it was a no money down deal, meaning that it wasn't any of my money that I put in. I actually raised all the capital. And the way that I started was I actually partnered with and still to this day, every deal that I do, I have a partner that I do these deals with, because I had to leverage off their track record, right? Which gets me to your question. The process starts with either knowing your track record or leveraging someone else's track record, because you've got to go back to the sales cycle to the point to where you've got to sell that broker on why you're the best option. If you don't have the track record, your partner may have the track record. And that's where, we can get a whole conversation about picking the right partner, right? Because at the end of the day, you don't want to just go with anybody. So our process starts with selling the broker on why we're the best fit from the very beginning. All right. And then, so we'll actually we'll obviously get the deal flow into our inbox. Then we'll underwrite the deals. I do what we call a litmus test, the same litmus test that I created for Grant when he first does a deal. Because if it passes the litmus test, chances are pretty high it's going to pass the larger institutional size underwriting that we'll do on it. So we'll run through the numbers. Then we'll go do a property visit. And that'll be just your preliminary tour, just to kind of see where the current upgrades are, if there are any, how many they've done, what the quality is, if you need to further increase that seller's current upgrades, see how much further you need to take it in order to get that rent bump. So we'll run through our numbers, and then we'll actually start the process with my equity partners and lenders early on, because I want to know where the deal's going to stack up especially with where we are in the market today. You don't have, you've got to remove as many errors as possible, right? Because you don't have time to make mistakes with where we are. Because if you want a deal in today's cycle, then you better know your numbers. And you're going to be paying arguably top dollar unless you can get some things off market, which, that's a whole nother conversation in itself, right? But
is there really an off market, or is it just something to select few?
Look, you don't want to get into the conversation about these LinkedIn brokers that, I got this deal, and look, they could be in Cincinnati trying to sell you a deal in Florida, and then they'll have stuff in California It's like
he's been partying in Atlanta, Gino. That's where this comes from.
Yeah, exactly.
The daisy chain of Atlanta continues.
The daisy chain. Then you got 15 people on it. Well, in my opinion, you actually open yourself up to liability because everybody's trying to get paid on something they're not even licensed to get paid for.
Mm-hmm.
So I can go on and on about that. So, but back to your question on process, I get the process started early on with the lender and with the equity partners, just so I know where we truly stand with all my bases covered. Because I know my renovation numbers, so I know when I go in what that's going to look like. So, and I get very comfortable at that point knowing how far we can actually stretch to get the deal if we need to. Because once again, the sellers aren't necessarily looking for the highest price in every single transaction. They're looking for a surety of close. And that's where the power of partnerships come in, is because you can leverage off their track record as well as your own to get the deal done, to give them that surety of close. And the more deals you close, the stronger your relationships get with these brokers, and then they start fighting for you at that point.
I like that. So what have you seen and the change in the market from where you started back in the recession to now? I mean, obviously, other than the prices increasing, of course, but what else have you seen? Rents, competition. What are the biggest things that stick out to you?
Yeah, so there's obviously a lot of competition. So there's two sides to what we do. We buy institutional size deals and we buy smaller, institutional size deals like 200 units and above, and then non-institutional size deals, basically things under 200 units.
Mm-hmm.
Things that are institutional size, so you're 200 units and above, you're going to get a lot more competition, especially from the institutional guys, as well as your regional players, depending on the market. Now, if you get into super tertiary markets, then you're not going to have a lot of competition. But on the smaller stuff, you don't really have a lot of competition on the smaller deals because it's too small of a check size for these institutions to fight for, to really care about. So that opens up a door for these regional guys and even the local owners and operators to come into play. The benefit that you have as a regional player is because a lot of the local people, they remember what that particular property sold for 5, 10, 15 years ago, and they're having a hard time wrapping their head around why these prices are justifiable today, because their own mind is clouded by what the particular market was. So, it's one thing about, being an outsider in certain markets is we're able to come in and scoop up a deal and not have to worry about the local guys. So, that's kind of what we see changing, aside from the rates and things that you talk about. Another thing that I see coming back right now is a lot of seller finance deals.
We like that. We like seller finance deals.
I've seen 3 of them.
Why are they coming back?
It's a good question. I mean, I just bought a portfolio in Chattanooga that is a seller finance deal. It happened to be owned by a local nonprofit. Look, they just saw a way of clipping a coupon versus having to go out and, in their mind, overpay for a property. So they're happy to take a little coupon and just moving on with their lives. There's a seller up in North Carolina that I came across that he was a local mom and pop guy. He didn't want to pay taxes because he bought the property that he was selling at a good basis. So he was willing to do seller finance up to 90% of the deal. And he was willing to factor in the renovation cost because he owned a contracting company. And
a little double dipping there.
Those are anomalies to the deal, right? I would love to find those deals all day long as you can come to an agreeable interest rate. But, you just don't find those deals every day. But I am starting to see those come back.
I like that. Benjamin, how do you go out and choose markets? Because it seems like you're in Chattanooga, you're in Nashville, you probably have stuff in Florida. It looks like North Carolina. What do you choose in a market? What do you like about markets?
Yeah, so I've got to know the market, right? So Nashville, Knoxville, Chattanooga, Atlanta, Charlotte, and throughout the Carolinas is kind of where our core focus is. I've got a lot of transaction history down in Florida. I don't currently have anything down there right now as we speak. But I am looking, but that's only because I know this pretty much the entire state of Florida like the back of my hand because I lived there for so long. But, look, I get deals in Denver, Indianapolis, Texas, of course. But I can't allow myself to go there, even though I can go in and wrap my head around a market in just a couple of weeks. But at the end of the day, I know my markets where we currently are. And the markets that I just mentioned where we are operating, it's a full-time job just staying on top of the trends in the local markets and where certain neighborhoods have been over regentrified, which ones are starting to trend in that direction. So with the markets that we have, was it 5? Look, you can't effectively know too many more markets than that unless you have a team of people that like an institution, they can focus on markets around the country, and that's the only reason they're able to do that. Whereas for us, we're lean and nimble, and just with those 5 markets, I mean, our hands are full.
Benjamin, I get this question a lot from students. What size population do you like in a market? I mean, I like tertiary markets because they're below the radar. You might get a little bit better cap rate, but if they're too small, you can't find qualified property management. What are you looking for as far as size in the market?
Yeah, so ideally, 100,000 plus. I mean, most of the markets that we're in, we're more than that. So we're in, Nashville is 2 million people now. Atlanta is, around 6 million. Knoxville, Chattanooga. I think Chattanooga is around 250. This all depends on where you draw your circle, right? Where you draw your radius. So good sized properties. I mean, good sized markets. But we just recently picked up some stuff down in Macon, Georgia, which we love.
Bilham territory.
Yeah, so it's a good little area. Now I wouldn't want overexposure, right? I wouldn't want too many properties in that particular area, but anything 100 units, maybe slightly above that, we'd probably tap out on a market like Macon at maybe 200 units, just because I don't want the overexposure. Whereas in Knoxville, we could have 600 units and be comfortable. But I don't know how many more properties we would want above that. Whereas in Atlanta, I could get 1,000 units and be comfortable.
Yeah, I like that. That makes so much sense. And the thing is, all the markets are different. Macon, I think, is more of a value play where you're going to get a higher cap rate, more cash on cash return, less cap appreciation. Whereas in Nashville, the caps are probably 4.5 to 5, where there's not really that much cash flow. So you're actually diversifying yourself and doing that also. That's awesome. That's really good. How do you select? Well, it's a hard question to ask because when you're evaluating a property in Macon, the valuation is different than Nashville. So let's just take Nashville, for instance. How are you buying a property in Nashville based on what metrics, and then going over to a property in Macon? What are you looking at to make the deal work for you?
And yeah, so this is one of those things you have to know your market, right? And so in Nashville, we actually ended up picking up a 475 unit portfolio there across 3 properties. It was an off-market deal. And ironically, a lender introduced me to the seller. And the only thing that they wanted out of it was if a deal got struck, then they wanted the right to do the debt on that deal. So we did that deal and ended up closing the properties down. And, that property, we ended up going in at around a 7 cap. And this was January of 18. So when everything in Nashville was trading at 5.5 to 5 3/4.
Yes.
And today things are still in the market at a 5 cap. And some of these are in great locations that will continue to trend upward. But these are all B class, properties that we're talking about. I don't get into A class deals yet, and and if you guys want to go in that conversation, we can. But I'll let you dictate that. But most of the properties we buy are B and C properties. So in Nashville, that is where the market is. And if you're able to pick up something off market from a seller that just wants the surety of close, maybe you'll get a deal. When you mentioned Macon, so Macon, it is a little bit different. So, things down there, look, there's brokers in that market that have stuff on the market for, at a 5.5 cap, and they'll try to get what they can. But Macon's not a 5.5 cap market, in my opinion. Macon is a 6 to maybe 6.5, if you can find that on a cap rate in that market. But look, the deal we just closed on in Macon, I love it. But we just got in there. We're only 2 weeks in. But but I've looked at Macon for probably a year, not chasing deals necessarily, but monitoring the market, just because I think there's some good growth coming to Macon. But I looked at that market for a year before we entered it. Like for instance, like we're looking in Virginia Beach area. We have not bought anything in that market, but I've been researching that market for a year, just so if the time comes, I'm prepared. So for me, it goes back to something you said a minute ago. You have to know your own backyard. You got to know your target markets and know that what one market commands, another market is not going to command, especially if it's something different like Nashville and Macon, Georgia.
Mm-hmm.
Right? So, that's kind of where that comes into play, and where Chattanooga sits right in the middle cap rate wise. And ironically, it sits in the middle almost geographically as well. But Chattanooga is a good little, I love Chattanooga. I love Knoxville as well. But you just got to know, you just got to know your markets. At the end of the day, your numbers have to work. Right. And so if you hit your internal metrics on any property you're looking at, no matter what market you're in, if you can achieve the scale, which obviously is what you want for management purposes, but if you can hit your internal numbers, look, there's properties I've bought where on paper going in, it was a 3.5 cap, but so many people blew it off because they didn't take time to dig into the numbers and realize, hey, there's numbers that you can change on day one, right? Payroll cost, R&M cost, general and administrative cost, some marketing costs. So depending on where that seller is, they may be inflating their expenses because for tax purposes, they want to keep their incomes as low as possible, right? And so, but there are certain things that you can actually go in. Like there's a property right now I'm looking at that we were just awarded. On paper, it's a 5.45 cap rate. But the reality of it is, if you take time to dig into the numbers, we're buying it at like a 7.25 cap.
Mm-hmm.
Based on your expenses. So right. How many times have you looked at selling that Nashville deal then? If you went at a 7 cap and now continue where the market is that thing just so you just itching to get rid of that or what? That's going to be a nice payday, right?
Well, yeah. Well, it's a turnaround story, right? So it's some heavy upgrades on those particular properties. The guy that we bought them from was, a slumlord. With all due respect, it's just what it is. Yeah. So my partner in that deal is a family over in Chattanooga. I'm sorry, not Chattanooga, Charlotte, North Carolina, and they're the ones that are controlling that conversation. But we get those calls all the time with brokers that are trying to bring us offers for that particular portfolio. And yeah, it's tempting. And we've had that conversation 2 or 3 times in the past 12 months, but we're still holding on.
So what is your strategy? Do you like to buy and hold, or is it unique to every property? Do you like to refi these things out? What are you trying to do with your portfolio?
Yeah, I think it's a good question, because I think with where we are right now, depending on the grade property that you're buying, our hold period assumes a 5-year hold on pretty much every deal that we buy.
Mm-hmm.
But we have 2 deals that we're getting under contract right now that I would argue that we could turn around and sell these deals in 2 years or less and make $20,000 a door on it. We don't come across those deals every day, but looking at how the numbers are trending, we may decide to hold it for 10 years just because it cash flows well.
Mm-hmm.
I mean, in this particular 2-pack, you're looking at a 12 to 14% cash on cash year one. Crazy. And those are real numbers. And when I underwrite deals, I'm not aggressive, but I'm also not super conservative. I'm right in the middle. And these deals, it's almost like an anomaly, right? Because, we have investors in our deals, like you guys have investors in your deals. I can't go out and tell these investors, hey, we've got a 13% cash on cash property. It's going to be a 24% target IRR. We maintain our current promoted numbers, which is an 8 pref with an 18 to 20% IRR, just because I don't want them to expect that 13% cash on cash and 24% IRR every single deal, because it's just not going to happen. But as they continue to come in, we'll continue to take them down. But you guys know how it is. You would rather under promise and over deliver versus the other way around.
Mm-hmm.
I know if something happens in that particular market on that particular property where it does not hit those metrics, then we know that we're going to at least hit that 8% pref with that 18% IRR.
So I like that. So 8% pref, 18 IRR. What is the promote on that? Are you 70-30, 80-20 on these things?
Yeah, so that's a really good question, because every deal is different, right?
Mm-hmm.
So a lot of deals, and it's a good lesson right here for people, is because every deal is different, right? So in this recent deal that we just did, it was a 70-30 split between the GPs and LPs. And we had one investor that pushed back on that, because this lady in particular, she was just so caught up in that 70-30 split, she thought it was too rich. So I ran the numbers on a waterfall of an 8, 10, and 12 that goes from a 20, to a 25 to a 30 split. And the straight 70-30 split worked more in the LP's favor than it did the GP's favor, whereas the 3-tier waterfall structure worked better in our favor. But she was so caught up in the 70-30 and not looking at the overall target returns that she really missed that opportunity. But it was a good lesson for us, is because we know that every deal is going to be structured a little bit different, just depends on what the projections are. But most of our deals are 70-30, but on a case-by-case basis, we will, structure that 2 or 3 tier waterfall.
So this is going to be probably a difficult question to answer, but how do you set investors' expectations? Because we had the same thing on our first deal. We did an A pref. Maybe we wanted to go to a 7 on the second one, but I think we probably would have gotten pushback, so we didn't. The 70-30 is another thing. Everyone out there, 70-30 is not bad. I thought in the beginning, wow, we're not putting any money in these deals, but we're putting our time, we're putting our skin in the game, we're signing on the debt, we're doing all the work. So, I mean, there's a lot that goes into a 70-30. We're not just sitting there getting rich and collecting checks, because there's a lot of operations going on. So how do you try to set those expectations to your investors? Maybe your next deal, you can't do an 8 pref. It's a heavier lift, so you can only do a 6 pref. So have you encountered that before, and how do you work through that?
Yeah, so it's a good question. So, we just came across that in Chattanooga. So these deals pencil very well. But the first year there was that lag that was slightly below that 8 pref, but we just simply let that be known throughout the entire conversation with the investors from the beginning that, hey, year one, at least for the first 6 months, we're not going to hit the numbers that you would typically expect, but there's going to be a ramp up period. Right. So for us, we just let that conversation come out from the very beginning, make sure everybody's on board, because you're right. If you promise somebody an 8 pref and then the next deal you go back and start, say it's a 7 pref, I mean, you can argue the fact that the market's continuing it's staying hot. Right. And so at the end of the day, depends on the debt that you end up securing at the end of the day, really helps dictate some of that. But you're right. It's a very tricky conversation because you'd rather go the opposite way, right? And that's one reason why I stick with these 8% prefs with the 18 to 20% IRR targets versus a 12% return with a 24% target IRR, just because I don't want them to expect that every single time. Otherwise, you're going to lose all your investors because they're going to go after and start chasing other people that may be enticing these investors to invest in deals that look good on paper, right? But the investor may not be savvy enough to know that, hey, these properties are actually in war zones, right? Whereas the ones that I mentioned to us, I mean, they are actually happen to be in really good spots. We don't get involved in any war zone based properties, but typically you would see war zone properties throwing off some pretty attractive numbers, but you got to go collect your checks with a Glock.
That's right. So how do you give the listeners a couple tips on how you actually cultivate the investors? I mean, on the first deal, it's difficult. After you do the first deal, those investors, if you've done well, they're going to invest in the second deal. So right. I'm starting out. Where should I go to start talking to investors? How do I propose the opportunity to them? Like, walk us through that. Right.
So networking, right? Because at the end of the day, you don't just build out an investor database, just 20 people from the beginning, right? So you got to go to the local RIAs. And I've actually got the first RIA I attended, I got an investor that invested $50,000, but I don't have time to go to a lot of those, but I do know that those opportunities exist because there are people in the RIAs that invest in single family that want to take that leap into multifamily. They just don't have that expertise. So I would argue the fact that there is certainly capital in those local RIAs that you can take advantage of to find capital for your deals. Obviously the friends and family route, you can always go that direction. You can go with recommendations and, having people make those introductions, kind of similar to what CrowdStreet does. So, obviously you can put your deals up on, these crowdfunding sources, but they're going to do their due diligence on you as a sponsor to make sure that you have the track record because they don't want to be embarrassed. Right. And so if you do have a track record, you can obviously get investors from there. But really it's just attending, like for me, I'd spend a lot of time in the family office space. So I get a lot of investors from there, and then attending a lot of these conferences and workshops and things like that. I mean, I know that you guys have these little getaway conferences that you do. People can come there and look, they can raise capital from other people that are attending. You can go to the, Grant's events, you can go to Tony Robbins events, you can go to any of these other people, because everybody is there to try to do better for themselves, financially, mentally, spiritually, whatever you're looking at. But as far as investors are concerned, it's just really getting out to these multifamily conferences and just rubbing elbows, shaking hands, and kissing babies.
Mm-hmm.
We've seen it time and time again, Gino. I mean, guys coming out to the events, creating partnerships, leveraging each other, and it's like what you said before. Finding the right partners and leveraging them. That's where the deals get done. They may bring some money to the table. Maybe they bring you a deal, and it's just putting the work in and getting out there, networking. It makes a huge difference for sure.
Mm-hmm. So before we get to the short answer question, Ben, where do you see your company going in the next 5 years? And maybe you don't have a crystal ball, but what do you think is going to happen to the market? I mean, are we going to stay hot on multifamily?
Man, it is a good question, right? So I'll answer the market question first. Man, nobody knows. All I can tell you is be careful. But I always will maintain this position. There are deals in the market, no matter where you are. That's why it's helpful knowing your market. And David Lindahl has a book that he wrote called Emerging Markets. I think it's what it's called. It talks about the 4 cycles to any particular market. There are deals in every single market out there. And if you can't find any in your particular market, let's just say you're in a super tertiary market, I would draw a radius, say an hour or 2 hours around you, and I would target the closest big city. I guarantee you there's deals still out there. Some people talk down on people starting with duplexes or quads or 25 units or whatever. I would say start where you can, because everybody's got to start somewhere. And all these people that are out, telling everybody these things, they're the ones that also started with duplexes and quads.
Hey, man, don't be hating on the 25 units, man.
Yeah, man.
Cut my teeth, brother. Come on now.
Exactly.
Everybody start with a 25 spot.
Yeah. Everybody had to start somewhere, right? So if you got to start with a duplex, start with a duplex. You don't have to start with a 200-unit property. But I will tell you that, yes, everybody knows that the larger deals take just as much time as the smaller deals, right? And the big deals pay better. But start where you can. That's one of my biggest recommendations. And to go back to your question about where do we see ourselves in 5 years, that's another good question, because with where we are in the market, if you were to ask me this question back in 2012, I would have some pretty lofty goals. But in 18, I had a goal of acquiring $100 million in property my first year in business, and we'd actually end up hitting $103 million. And we've already gone on to today, we're at $140 million. So we've raised just over $40 million that we've raised from investors in the past 18 to 24 months. That, look, the money's out there. The money's looking for deals, but you got to take time to build trust. So for us, we're continuing to build trust. We have a lot of repeat investors. We're getting a lot of new investors. So the more investors we get, the more deals we can acquire, because I've got a pipeline so full right now that I was tossing and turning in bed last night, wondering how I'm going to get them all done if they all came, to be awarded to us. And out of the 4, we have 6 in the pipeline. We've got 3 that we've been awarded right now, and we got PSAs working on every single one of them. And I'm wondering, I know we get it done, but I'm gonna put this partner in this property, this partner with this one, and this one with that one, right? And so it helps with leveraging workload. So
don't freak out, man. I feel like you
worked
up
good.
Here, man. Don't freak out, man. Don't freak out. Honestly,
it's good. But with them, we can continue growing as long as we can continue keeping our investors comfortable and our partners comfortable in every deal that we do. So far, so good. So I would love to, in 5 years, I would like to double every single year. But is that feasible with where we are in the market? I wouldn't say it's not possible, but I would say it's going to be an uphill battle. But it's one we're prepared for. Because we've been, like I mentioned when we first got on, it's been 15 to 18 years in the making. So it's not like we just woke up yesterday and said, "Hey, I'm going to start a firm," and expecting to do $100 million in my first year. It took time to get there, right? And I don't know everybody is going to be able to do that, but just like you guys, with where you started, I know that you promoted, hey, if we can do it, anybody can do it. Well, it's true, because everybody starts somewhere. You may have grown up in the business. Maybe you didn't grow up in the business, but at the end of the day, it's all about execution.
Very cool. All right, gang, let's take a quick time out to hear from our sponsor. Gino, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. I know that you've been hard at work helping Jake and Gino students do just that using our framework. Can you explain to the listeners how they can get our help?
Guys, we've been hard at work growing our community of like-minded investors, and the results of our members has been nothing short of incredible. We're looking to grow this amazing group. What we're looking for is those who want to follow our proprietary framework that we've created. Buy right, manage right, and finance right. Leverage our connections, education, and mentorship as ways to take your business to the next level.
So if you're interested in finding out more about how you can become a part of our amazing community, apply to work with us at jakeandgino.com/apply. All right, and we're back. So you mentioned the difference between A class and B class, and you're talking about your time at Cardone Capital. How do your deals differ from the deals that you did with Cardone Capital?
And yeah, so the deals that I do now is same deals that we did at Cardone Capital when I was there, which was simply B and C class properties. We've continued to maintain that because I feel that B and C class are somewhat insulated, because the people that are in the A class properties, right? And let's just say that something happened in the economy, and I don't expect it to, but if it did, because nobody knows, those people start losing their jobs. Where are they going to go? They can't afford the $1,700, $2,000 a month rents anymore. So they're going to fall down to the B class, right? And the people that are in the C class want to come up to the B class, right? And so with the B's and C's, they're somewhat insulated because you can keep them full, arguably, and then there's still some room to run in the rents. Whereas the A class, and this all goes, on a market by market basis, of course, but so this kind of a blanket statement, but I really don't think the A class has much room to push. And so you see people promoting these A class deals in the market. They better hope they hit the numbers that they're promoting in the marketplace, because I would be scared if I was an investor in some of these deals.
That's interesting, because I don't know much about it, but I thought Cardone Capital was more A class properties, and that's where
they are now. They are now.
Gotcha. So
yeah.
a little bit different strategy there.
Yeah.
On the personal success side, what is your best habit for success?
It's execution. I mean, at the end of the day, it's what it's all about. You don't have to know every answer to every single thing. You just got to execute. I mean, one partner that I have, he's an engineer by trade. And look, he owns 6,000 units right now, but he has an engineer background. So he tends to want to know everything from A to Z, how it's all going to work out. And for me, I don't have to know everything from A to Z. I would like to, but at the end of the day, you just got to get in and grind it out, right? And you'll figure out how to make it work. Once you get in there, you'll figure it out.
Gino, I think you just said make it happen. Just get it done, man.
Just get it done. So that's really my thing, man. It's just, and I know it sounds simple, but it really comes down to that. Just execution.
So his core value is execution. He's going to go on the back of his shirt. What about a tip for scaling? A lot of folks get into it and it's like, oh, now what? Any tips for scaling a business?
Yeah, so that's a good thing. So I speak at a lot of these multifamily conferences, and that's one thing that I speak on is acquiring, how to acquire, own, and manage 50-unit properties, right? And so with these smaller properties, so I think you really start achieving scale, and this all depends on where your management partner comes into play, because it really depends on the fees that they charge you from a management fee perspective. Depends on what number you have to hit in order to comfortably enter a market with a small deal, right? So for us, when we bought in Chattanooga, we were able to go in and buy a 116-unit portfolio, which is 5 properties, but we were able to buy an already assembled portfolio, which is where when we entered the Atlanta market, I had to acquire a 50-unit, and then immediately we got a 76-unit, and then immediately after that we get a 44-unit. Now we have 100, now we get another 56, and so it keeps building and building. So now we have some pretty good scale in the market to where now our management partner has reduced our management fees from 4% down to 3%, because now we have so much scale with them So for us, if I were going into a market or just starting out, I would go in with the mindset of hitting at least 100 units in a particular area. It doesn't have to be 100 units at one time, but at least let that be your goal to bump up to that position, whether it's 425 unit properties or whatever, or 250 unit properties. But I would do that because the last thing you want is to get involved in the management game, because it's a lot of work and you don't want to deal with those phone calls and those headaches. You want to let somebody else handle that, and you just watch over their efforts and just monitor the numbers, make sure they're hitting the numbers according to your budgets. But, for me, it's 100 units. But for somebody else, it may be different.
What about something that you should have done differently when starting out? Was there a mistake where you're like, man, I wish that we would have went even faster if we didn't do that, or something to, a roadblock to, have folks watch out for?
It's a really good question. I'm thinking as you're asking me that, because I kind of knew how the question was going to end. But for us, because we were prepared, over the 15 years, the only thing that I would have done different was started my own, just started doing it sooner on my own account, right? Because that's
a great answer though, because someone may be sitting there, like you said, having, the over analysis going on, and they're just sitting there stewing about it, when just get out there and let's go, man. What are you waiting for? Right?
Just do it. Just get it done. Because my philosophy is this: if you buy a piece of real estate, worst case scenario, you're going to break even. Unless you just make a dumb decision, that's the only way you're going to lose money in real estate, right? Because you can at least break even. Ideally, you're going to make money, but at least just get out there. And if you find crap, I shouldn't have bought this deal, just sell it for what you got in it. Just get out of it. If it comes down to that. So, for us, I just spent so much time making other people wealthy and, building up their portfolios that I just got to the point to where, like, look, I'm ready to run, man. Because look, there's a lot of real estate books and courses and stuff out there, podcasts, you name it. They're all super helpful. But at some point you just got to move, just go for it.
Yeah. But to your point, Benjamin, even if you do lose money, so what? It's just money. You can make money back. You can't make time back.
That's correct.
That's the problem. And I think people, when you're younger, you don't look at it that way. But I'd rather lose money and learn something, and then maybe the next deal I won't crap out. People are more afraid of losing than they are of winning. That's the real problem. That's the real mindset that we all have to work on. It's okay if you lose, because what is losing? Losing money, so what? You take it as a write-off, you learn your lumps, and then you can go on and execute. What did I do wrong there? If not, if you're sitting on the sideline and not doing anything, you'll never learn anything. So I didn't mean to interject. I just think that's a really important point.
No, Gino, you've lived it though, man. You had the mobile home park deal back in the day.
And a few.
And you wouldn't be sitting here now if that was the case.
Well, the funny thing is, I lost on that one deal $172,000, just like one of the other podcasts. I lost maybe $300,000 in a strip mall. 5 years later, we've refied out over $9 million. So who won? You know what I'm saying? I lost 400. You know what I'm saying? I just, you know what I'm saying? Like, I'm not saying that it's braggadocious or anything, but I got my ass kicked like everybody else. But I had so much pain on my current job, just like you did, Benjamin, probably working for somebody saying, I don't want to be doing this. It's just a job. I want to create my own. That I got out there and I really learned, and I really took my lumps and all those mistakes. What was I doing in a mobile home park? What was I doing in a strip mall? What was I doing in New York investing there? I actually learned what a market was. I actually learned how to invest outside my backyard. I actually learned how to deal with a property management company. I actually learned how to buy these deals, put them under contract, run them efficiently, raise the rents. It's not rocket science. There's some steps to do it. Don't expect to learn it in the first 6 months. It'll probably take you 18 months like Jake and I did to get in your first deal if you're coming off fresh. But what is 18 months? And then after 3 years, I will guarantee you, the next 3 to 5 years, if you really put in all the work, you're gonna become financially free, especially if you choose the market and you choose partners. That's the bottom line, and I'm testament to that. Jake did it even quicker. We can get into cost seg, we can get into all this other stuff that'll accelerate it even faster. I don't want to blow everyone. I don't want to make everyone get overwhelmed by it, but that's the truth. You know what I'm saying? That's why education and financial education is great. You know what I mean? If you become financially educated, you'll realize that multifamily is just a vehicle to get from point A to point B. It's an awesome vehicle. There's a lot of really great vehicles,
in my opinion. I mean, 100%. Because look, when I made the decision to launch out on my own, I went from, my net worth at the time was $25,000, and in 18 months I took it to $5 million. It's a 20,000% increase. Now, look, those are crazy numbers, but I say that in hopes that someone's encouraged by it, because at the end of the day, look, even if you hit half that, depending on where you are, if you hit 10,000% increase or even 100% increase, that's still impressive, right? And so that's just the power of multifamily and what it can do for you if you do it right. But, you know, I would say on someone's first deal, don't overextend yourself. Just get in and get started. Start with a 25-unit property. Start with a duplex if you have to. It doesn't matter, but just start somewhere, because the last thing you want to do is put a 300-unit property under contract, if you can get it under contract, right? Because if someone with no experience can get a deal under contract that's 300 units, you have to wonder why a larger institution did not look at the deal. Because you got to wonder, why is the broker giving you the deal and not someone else? Because there may be something wrong with it, right? So that's why I say just bite-sized steps. And I know it's the opposite of what some people teach, just go big or go home. And look, I agree with that philosophy. But at the same time, if you don't want to toss and turn in bed at night, especially if you don't have a lot of investors, then, you know, I would just start where you could.
It's the old football saying, take what the defense is giving you. If we're at 25 unit, it's okay. You can grow from there. And ultimately, I think everyone understands that you want to be in the bigger deals, but you got to take what you can take down at the time. And we mentally, when we started, we're prepared for a 25 unit. That's just where our freaking heads were at.
Correct.
And then it's like, oh shit, this is not, you know, we can do this. There's no reason we can't do 100 units. So everyone goes through a different mental journey. And that's why it all comes back to mindset. And it sounds cliche as shit. And everyone's like, oh, Tony Robbins, the woo, blah, blah, blah. It all comes back up here. You know, if you can get your mind wrapped around it, you can take it down, you're going to do it. So
yeah, look, where you see Grant buying today, you know, $100 million properties, right? He started out in a single family home, right? And then a duplex, and then went on from there. So the people that are teaching you not to start there are the people that actually started there, right? And so I would say, if that's where you got to start, then start. Look, that's where Arnold Schwarzenegger started, right? Many people
He's
know
doing it right for himself.
Yeah, exactly. And it's like, just do it and just scale up, you know, because at the end of the day, it's like, it just depends on where you want to go. And for me, I want 10,000 units. You know, we're not there yet, but we're on our way. You didn't just start overnight.
You mentioned you're like really pounding the Audible and going through a lot of books. Any book recommendations? Doesn't have to be real estate that made an impact on your life that you want to share with the listeners.
And yeah, so gosh, Jim Collins' Good to Great. I read that book. Built to Last. That's another one of his books. The Art of the Deal, which is a classic for many people. That's one of the first business books I ever read. And it just helps you think outside the box, because what Trump was able to do with building some of these high rises, there were some workarounds that he actually created. He would buy air rights from the neighboring property and would be able to stack up more height because he purchased the neighbor's air rights. And being in New York, we don't probably get that concept a lot, but there you have to go vertical, and you have to go vertical pretty high to make the numbers work. But it just helps you think about, man, what are some creative ways I can just get this deal done? And that book was really good. I mean, it had a lot of, you know, real estate lessons in it, of course, but the book wasn't just about real estate. It was just more about just creative structuring of deals. So that book, Jim Collins, I mentioned, Blue Ocean Strategy.
I love that one.
I really love that book.
Yeah.
I've got it in audio, and I bet I've listened to it 3 or 4 times. They have a new one out. Forget the name of it, but I have it on audio. I just forget the name of it. It's slipping my mind right now, but same authors. But that's the key books, other than the David Lindahl book that I mentioned, The Emerging Markets. You know, that's a really good book for anybody. And anybody just starting out, there's one called something like 31 Key Metrics of Cash Flow that every real estate investor should know. I forget the author, the exact name, but something like that. But it's a really, really good numbers-based book that just helps you understand just general underwriting terms. That's probably a good one that I would recommend to someone that, you know, it's always good to fall back on just to kind of get reminders.
G-Dad, I mean, I saw you stern over there. Don't hold it back on me here. What's going on?
I want to make a little, I wouldn't say controversial, but I mean.
Oh, shit. Here we go.
I'm not a huge Trump fan, right? Yeah. I like what he's doing. I don't like what he says. I don't like, but if anyone out there thinks that he's a stupid guy, just read that book.
Yeah, 100%.
What he did, I can't believe the stuff that he does, and he still doesn't get credit. He created one of the most amazing TV shows. I hate the show personally, but that brand, now he's created his own Trump brand. And what he did in New York City back in the 80s, which was it was a hole there. I mean, and he wasn't even putting money, his own money into these deals. Talk about, I mean, if that's not the height of intelligence, I don't know what is, bro. He's getting money from everybody. I mean, to do the ice skating rink over there, whatever it was, read that book. I mean, you might like him, not like him. I'm a logical person. My wife works more from the heart. She's more emotion, feeling. Use your logic. Read the book. And there's a lot of really great tips in that book. I read it after you got argued. I'd never read it before. It was back in the 80s. So real estate has not changed. Right. Being creative. That's the amazing thing. People could not afford to buy a house 30 years ago. They couldn't get the down payment. They can't get it today. There was no money back then. It's just the same exact thing. And if you can read books from back then and glean what they're talking about, I mean, that was an awesome book. I really enjoyed that book. So
yeah, good point.
All right, we're winding down here. So what is the best way for listeners to get a hold of you?
Yeah, so they can email me directly. It's binman@inmanequities.com. My personal cell is available to anybody for text or call. It's 615-513-3088. There's always inmanequities.com, which is our site. I'm on all the social media platforms at Inman Equities. So I'm very, very active on social media, specifically LinkedIn, Twitter, Facebook, and Instagram.
G-Father, take us home.
Few points we have to really hit on, Jake. First thing is you have to commit first, and then worry about the execution. I think it's not going to be overnight. I mean, I don't think anyone's going to go out there in the next 6 months to get their first 100-unit deal. A lot of work takes place, right? Fall in love with the process. Don't fall in love with the goal or the outcome. That's really important. So if you can fall in love with underwriting deals,
calling brokers.
Yep. Yeah, that's really important. And we didn't mention it, Jake, but the three-step proprietary framework: buy right, manage right, and finance right. Benjamin's been hitting on it. All three of those throughout the whole podcast. You got to buy right. You got to know your market. You've got to manage it. You need to take down a great management company. That's why I asked him about the number of people in a market. And, finance right, we didn't really touch on it that much, but it is. We've been talking about syndication and about getting investors out there. What else do I got? Those are some of the main things, and really creating your investor base and just start going out there and setting expectations for investors.
Yeah, 100%. Because look, at the end of the day, I would end with this. Don't go for the get rich quick. Go for the get rich for sure, right? And real estate has made more millionaires than any other industry on the planet. And so, it may take you 10 years. It may take you 18 months, but just go for it. Just set your goals down and just execute, because real estate can make you very wealthy.
And you know what? Sure. Go get rich. It's fun. There's nothing wrong with that.
It feels better than being broke.
Hell yes, brother. Benjamin, appreciate your time today.
Yeah, thanks guys.